In markets, information is supposed to move price. That's the fundamental assumption most participants operate under. When a significant rumor enters the system, especially one tied to infrastructure-level adoption, you expect volatility, expansion, attention. But what happens when the opposite occurs? What does it mean when the rumor grows louder and the price grows quieter? XRP is currently sitting in that exact contradiction. On the surface, nothing is happening. Price remains compressed, movement is limited, and volatility appears almost artificially suppressed. To the average observer, this looks like stagnation, a lack of interest, possibly even a lack of relevance. But that interpretation assumes that price is the leading indicator. It isn't, and this is where the situation begins to shift. Because when price stops reacting to information the way it should, it usually means one of two things. Either the market has already fully priced in the narrative, or something beneath the surface is absorbing it. But that's not the most important part. What matters more is understanding why this silence exists in the first place, and who benefits from it staying this way. Because once you see that clearly, the current phase stops looking like inactivity and starts looking like positioning. There's a reason this rumor isn't being discussed openly at scale. Not because it lacks significance, but because of what it implies if taken seriously. At the center of the conversation is a growing narrative that the XRP ledger could be integrated, directly or indirectly, into systems historically dominated by SWIFT. Not as a replacement in the immediate sense, but as a parallel layer. A settlement rail that operates alongside existing infrastructure rather than attempting to disrupt it overnight. Now, to be clear, this is still a rumor. There is no formal confirmation, no official statement tying these systems together in a definitive way. But that's precisely why it matters. Because markets don't move on confirmed certainty. They move on credible possibility. And this is where it becomes interesting. If even a fraction of this narrative is accurate, then XRP is no longer being positioned as a speculative asset competing for attention. It becomes something else entirely, a liquidity bridge embedded within the architecture of global finance. But notice the restraint. Notice how this isn't triggering widespread excitement. No explosive headlines, no immediate repricing. That absence of reaction is not accidental. Because if this were fully understood, the implications wouldn't unfold in a single move. They would unfold in phases. And most participants are still stuck looking for the first one. If the rumor carries this level of potential, then the natural question becomes obvious. Why isn't the market reacting? Because from a surface-level perspective, it should be. Narratives of this magnitude typically trigger immediate speculation, rapid inflows, and aggressive price expansion. That's the pattern most participants have been conditioned to expect. And yet, XRP remains contained within a narrow range, almost indifferent to the conversation forming around it. That behavior feels irrational until you stop looking at it through a retail lens. This is not a failure of demand. It is a restructuring of how demand is being expressed. What you're seeing is not absence, it is absorption. Liquidity enters, but it doesn't chase price higher. Instead, it gets met with supply. Controlled, measured, consistent. The kind of supply that doesn't panic, doesn't rush, and doesn't disappear under pressure. That type of behavior doesn't come from short-term traders. It comes from entities operating on a completely different time frame. And this is where most interpretations break down. Because when the market doesn't reward a bullish narrative immediately, retail assumes the narrative is weak. In reality, the opposite is often true. Strong narratives don't need validation through instant price movement. They require time to be positioned around. And this is where it becomes even more important. Because if this phase is indeed absorption, then the eventual move doesn't begin with excitement. It begins after indifference. And this is where the behavior of institutions begins to diverge sharply from everything most participants are used to. Retail waits for confirmation. Institutions position before it. While the broader market debates whether a rumor is credible, large capital is asking a different question entirely. Not is this confirmed, but what happens if this is even partially true? That shift in perspective changes everything. Because when the upside scenario carries asymmetric potential, positioning early is not reckless. It is calculated. We've seen this pattern before. Not just in crypto, but across traditional markets. Exposure appears quietly, often through indirect vehicles, long before narratives become mainstream. By the time the average participant feels comfortable, the majority of the move has already been structured. And this is where it becomes difficult to ignore what's happening beneath the surface. Capital linked to major financial institutions has already shown interest in XRP-related products and exposure pathways. Not aggressively, not loudly, but consistently. The kind of positioning that doesn't aim to move price in the short term, but to secure access before conditions change. But that's not the most important signal. What matters more is the patience behind it. Because institutions don't allocate based on hype cycles. They allocate based on probability distributions over time. And right now, the distribution they're modeling may look very different from what the market sees. But even with institutional interest quietly forming, there has always been one variable capable of halting everything: regulation. For years, XRP existed under a cloud that most assets never had to navigate. Legal ambiguity, enforcement risk, and the constant question of classification created a ceiling that price alone could not break. It wasn't just about demand, it was about permission. And this is where the shift becomes subtle but critical. Because the conversation around regulation is no longer centered on whether XRP can exist within the system. It's beginning to focus on how it fits into it. That is a completely different discussion. One implies exclusion, the other implies integration. This is not about a single case or a single ruling. It's about trajectory, the gradual movement from uncertainty toward definition, from risk toward framework. And institutions do not wait for perfect clarity. They wait for sufficient clarity. That threshold is often invisible to the public, but when it's crossed, behavior changes. Quietly at first, allocation begins to increase. Exposure becomes easier to justify. Internal resistance starts to fade. But here's where it becomes more interesting. Because regulatory clarity doesn't trigger immediate price expansion. It removes friction. And once that friction is reduced, other forces begin to matter more. For most participants, that shift goes unnoticed. Until it doesn't. When you step back and connect all of these threads, the picture that forms is not one of speculation. It's one of repositioning. A persistent rumor tied to global payment infrastructure. Quiet but deliberate institutional exposure. A regulatory environment that is no longer restrictive but gradually accommodating. None of these elements on their own force immediate price movement. But together, they begin to define a different role for the asset entirely. And this is where most investors misread the situation. They are still evaluating XRP as if it needs to prove itself through retail-driven demand cycles, through hype, momentum, and rapid expansion. But that framework is outdated, because what's unfolding here is not a competition for attention. It's a transition into utility at scale. If XRP is being positioned as a liquidity layer within financial infrastructure, then the current phase makes sense. It needs stability. It needs depth. It needs the kind of market structure that can support large flows without disruption. That does not happen during explosive moves. It happens during compression, and this is why the market feels slow. Not because nothing is happening, but because what is happening is structural. But that leads to a more important realization. Because if the role is changing, then the way value is expressed will change with it. And most participants are still looking for the old signals. What most participants are waiting for is a signal that feels familiar. A sudden breakout, a surge in volume, a moment that validates their patience in a way that is visible and immediate. But those signals belong to a different phase of the market. Right now, the conditions are doing something far less satisfying but far more important. They are filtering. Low volatility, declining interest, and extended consolidation don't just reflect inactivity. They create fatigue. They test conviction. They gradually push out participants who require constant validation from price. And in doing so, they change the composition of who remains. This is not accidental, because strong trends rarely begin when everyone is watching. They begin when attention has moved elsewhere, when narratives feel stale, when even bullish investors start questioning whether the opportunity still exists. And this is where it becomes difficult, because the move most people are waiting for doesn't start with confirmation. It starts after doubt reaches its peak. Liquidity conditions tighten, participation drops, the market becomes quieter. And then, without warning, structure shifts. But by that point, positioning is no longer easy. Because the same compression that created opportunity also removed accessibility. Price moves faster, entries become less forgiving, and hesitation becomes costly. So the real question isn't when the move happens, it's who is still positioned when it does. And this brings us to the calm, high-conviction conclusion that most participants will overlook. The paradox is clear. The rumor that should trigger chaos hasn't. The price that should explode remains contained. The market that should feel exciting feels indifferent. Yet, beneath the surface, everything is aligning. Institutional exposure, regulatory clarity, and strategic positioning are converging. The narrative isn't being played out through headlines or retail sentiment. It's being played out quietly, deliberately, over a time frame most investors aren't willing to endure. This is why patience is not optional, it is essential. Because the opportunity is not in reacting to the rumor, it is in understanding why it hasn't moved the market yet. That understanding allows you to see the structural forces at work, while others misinterpret the silence as weakness. What you are witnessing now is not stagnation, it is preparation. Not hype, but positioning. Not volatility, but depth. And those who recognize this early are not chasing price. They are observing value being embedded. The most powerful moves in markets rarely announce themselves with noise. They whisper. They require conviction, they demand discipline, and when the move finally comes, it won't feel like the beginning. It will feel like a continuation of something that has been quietly building for months, something most participants assumed was over or irrelevant. This is the opportunity. Quiet, patient, and profoundly asymmetric. And it is available only to those willing to look past the immediate, to understand the underlying forces shaping what comes next. Silence is not absence, it is the signal, and recognizing that signal is what separates those who act from those who wait too long.